Ladies and gentlemen, you're listening to Working Capital, the real estate podcast. My name is Jess Fragale, and returning guest today is Brian Burke. Brian is president and CEO of Praxis Capital Inc. He's probably been on the show now 2 or 3 times at least. Praxis Capital is a vertically integrated real estate private equity investment firm, which he founded in 2001. Brian is also a member of the Praxis Investment Committee. Praxis operates on multiple platforms, currently managing active syndications for the acquisition of single-family, multifamily, and opportunistic residential assets in U.S. growth markets. Brian, welcome back. How's it going?
It's going great. Thanks for having me back again.
Yeah, it's always a pleasure to have you on. We're just kind of saying before the show, I don't know if it's been 6 months, a year, things have been moving fairly quickly in different areas of real estate and different areas geographically. So would love to get your take on some of the recent developments in the market. Before we do that, for those that haven't listened to the last couple episodes, maybe you could just give a little bit of a backgrounder as to who you are and who Praxis is.
Yeah, we're a national multifamily operator. We specialize in Class A and B multifamily assets in growth markets across the U.S. We're a lot less focused right now because at the peak of the market in 21, 22, we sold almost everything we owned, or at least 3/4 of everything we owned, thinking that it looked like there was going to be a change in the market coming, and it turns out we were right. So I wish I could have sold everything I owned, but we just couldn't get to it all in time. But now we're just kind of watching waiters, where we're on the sidelines of the market waiting to get back in when the timing is right, which I haven't seen that moment yet. So right now we're not really doing a lot.
Yeah, it's funny. Last time you were on the show, I think we were going through the, is this bio still right? It's like, we own this millions of, thousands of units. We don't own this many thousand units anymore. What was that trend like? For those that didn't hear that podcast, you were at your peak, you were at what, and what did you end up selling off during? I think was it 2021 that the sale started?
Yeah, we started in 21 and we finished off in early 22, and then the market seemed to collapse in mid 22. So the timing couldn't have been much better. But we had about 4,000 units. We sold about 3,000 of them. I think we're just under 1,000 units right now, around 900 or so that are left. So we managed to get out of most of them just in the right nick of time, which was a pretty good thing.
So what was that process? Well, I guess to back up, have you ever been in a process where you've sold that much in such a short, relatively short amount of time? And what was that process like?
Yeah, we've always been buyers and sellers, and we've always had inventory coming in, inventory going out. But to have that amount of inventory going out in that short of a period of time without any inventory coming in was a bit of a departure. But it was what the market was telling us was the right thing to do. I mean, when we were getting outbid on everything we were trying to buy by several $1 million, and we were getting offers on stuff we owned that was millions of dollars more than we could ever imagine selling them for, the market was giving us the signals that it was time to sell and not time to buy. And that's exactly what we did.
Was there any kind of details on the negotiation that would be out of the norm because you were selling? Was there any thinking on the buyer side that you had to sell because you guys were unloading quite a bit, or was it kind of just straight up, this is the valuation and this is our price?
Yeah, no, there was no discussion like that. In fact, every deal that we put up, we had at least a dozen offers, some of them as many as like 24 offers, wow, all over the asking price, all with non-refundable earnest money deposits. We had no pressure to sell. We just felt that if everybody out there really wants to give us top dollar for our real estate, why should we stop them? Let's let them have it. And we didn't have to fight that at all. It was it came to us.
It's a good problem to have. For my brokerage guys and gals listening, what was the process like for you choosing brokers in this situation? I know that you're in multiple markets, so I assume it wasn't just one brokerage.
It wasn't just one brokerage. Mostly it was, the brokers that brought us the deal would be the brokers that got to sell the deal. And in some cases, We had a few properties that we transacted where brokers came to us with an offer. And in a couple of cases, we actually had multiple brokers coming to us with offers. And in those cases, it was just a matter of, picking the best one.
So was there a situation where maybe one of the properties was on the bubble, but you had a broker bringing a compelling case to you and decided to sell it?
That was what started the whole thing, actually. Was we had a property that was not for sale, and we got an unsolicited offer to buy it. And the offer was like, we thought it was crazy. And it's like, okay, if you're going to pay that, it's yours. And then that's when we started talking about it and thought, like, is this a one-off fluke, or are we going to see more of this? And so that's why we then decided, let's try selling some of these properties. So in some cases, we would just call brokers that we'd worked with that sold us the property and be like, hey, do you got anybody that wants to buy this thing? When it got down to the very end, that's when we really played it a little bit differently. In early 22, we really got to thinking that the peak of the market was really close. And at that point, I called the broker that sold us one property and the broker that sold us a different property. I called each of those two brokers and I said, I want you to take this deal out to your best buyers, and I want you to bring me offers in 2 weeks. And, I didn't think we had time to do an offering memorandum, take pictures, do all that, do a 30-day marketing, set up tours, and go to best and final rounds and all that typical stuff. I felt like if we did all of that, the market was going to pass us by. So I said, bring me the offers from your top clients in 2 weeks. And they did. And they both brought me multiple offers in 2 weeks. And that's how we got those last deals done. And then the market fell off the cliff, and we knew we were done selling at that point because now we'd lost our opportunity to get more than top dollar.
Yeah, that's wild. I do want to relish in the fact that there was an unsolicited offer from a broker. Like Brian's he's a pretty big deal. So the fact that for all the brokers listening, go sell. I mean, a lot of times it does that conversation, whether it's in industrial, office, apartment. A lot of times you're the kernel of the idea that gets something going.
That's exactly right. And, it's always nice when, brokers always want to call and say like, oh, hey, we can get you this or that for your property. And I've got all kinds of buyers and all that stuff. And I hear that all the time, like, oh, I got 5 buyers that want your property. It's like, really? I don't see any offers in my inbox. But when they come at me with an offer in hand and be like, look, I've got this buyer. And I think it was a situation where they were buying nearby or something. And, this was a motivated buyer, right? They wanted this property because they wanted to combine it with other assets they were acquiring or some kind of story like that. And when they come at me with an offer with, hard earnest money and it's, and it's a really good offer, it's smart for us to listen to that.
Yeah, for sure. Paper talks, as we like to say in the office. So Brian, I had a conversation with, I would say one of our larger real estate companies down in Toronto. And we were talking about the fact that a lot of the individuals that get into this industry, even if their background is in accounting and finance or economics, that the actual structuring of the deal, in your case in syndications, first of all, it's not taught in school, but it's also not really taught in business school or applied school. And it reminded me of you because he asked me, well, how did you decide on the splits, like the waterfall? And I was like, well, number one, the term waterfall, there was too many falls in that like program of having different tiers. And so a lot of it was you and I had some back and forth listening to different podcasts. Joe Fairless has a lot that, on syndications. So long story short, you created or you wrote a book, I believe it Passive Real Estate Investor. Do I have that right?
The hands-off investor.
The hands-off real estate investor for passive real estate investors from their point of view, which you don't often see. And I wanted to chat about what the kind of primary reason you wrote that book and what you're trying to address with that book or who that book is for.
So the book was born out of 2 separate observations. One observation was in this business, we talk to a lot of investors in this space. And a lot of them are accredited investors. And the word accredited gives you the impression that it means that they have a high degree of skill in how these investments work. But in talking with a lot of accredited investors, you learn that they don't really know much about this space. They aren't asking the right questions. There's things that you think they should know that they don't. And I realized that there was really no good resource for those investors to learn those skills. So that's why there was a knowledge gap. That was one observation. The other observation is a friend of mine lost her entire life savings investing in a failed syndication. And I felt like if there was anything I could do to prevent that experience from happening to one person, then the effort would be worth it. And the effort would be to write this book to fill that knowledge gap that I found was out there. And hopefully by filling that knowledge gap, people would make better decisions and I could prevent someone from losing their entire life savings. And it was a really rewarding experience to write a book. People told me for years I should do it. And I'm like, nah, I'm not doing that. But I've gotten a lot of great feedback as a result.
So part of this kind of selling of these multiple assets, the limited partners, obviously, depending on how the structure of your agreements are, that there could be a liquidity event that they get capital. What I'm curious about is you mentioned that this is somewhat rare for you to be selling so much without buying. The idea of holding people's capital, and not being able to deploy it is obviously a drag on the capital. So in this type of situation, what typically happens? Are you giving the capital back to investors and saying, hey, listen, we're going to let you know, when we go back into buy mode and come back for the investment, or is there some other type of arrangement that you work out?
Oh yeah, this is their money. We're not currency purgatory. When the investment is completed, you get your money back. You get to touch it and feel it and fall back in love with it before you have to part with it again. So no, we return capital to those investors, and they're free to do whatever they want with it. And we did set up a debt fund, and we are buying real estate debt instead of buying real estate because I like that place. I like being in a higher priority in the capital stack right now when things are a little shaky. This is a good place to be. It's not a sexy investment. It's not high return, but it's kind of one of those, steady Eddie kind of things, which is really nice place to be in times like this. So a lot of our investors deployed capital into our debt fund. So that was one place they went. Some investors put it in a money market. Others invested in stocks. Some probably invested in other syndications that they probably now wish they hadn't. It's a variety of things. I'm not going to hold someone's money and have pressure to feel as though I need to deploy that capital and make subpar investments just for the purpose of deploying capital. We're not in the capital deployment business. We're in the investment business and providing returns for investors. And we want to make sure that when we're deploying that capital, that we have a very good feeling that we're actually going to be able to fulfill that objective.
For the debt fund, what does that look like for Praxis? Is it a specific type of debt, or how did that kind of area evolve?
Well, it evolved because several years ago, I guess about 6 years ago now, maybe 7 years ago, I started a loan origination company with a couple partners, and we were originating bridge loans to real estate investors. And we're talking about single family fix and flip investors, rental pools, new ground up residential construction, small multifamily repositioning, that kind of stuff. And the way that we were able to originate over $2 billion in loans with a limited amount of capital is we would originate a loan, and then we would sell the loan to one of our institutional partners. And right at the peak of the market, when I was selling all of our apartments, I sold that company. And when we sold it, we realized that being on the other side of that transaction really was a nice place to be as well. And especially in this kind of a market, it's a really good place to be. So we started this debt fund, and what we're doing now is we're buying loans from our old company. So we have the deal flow right there already. We know what the loans are. We know who's originating because we hired all those people. And it was just kind of a natural progression of our business. If I was a multifamily specialist that had never done anything on the debt side, I wouldn't ever dream about, branching off into something like this. Mm-hmm. But for us, it was just a natural extension.
And I think it's, for those listening, it might come off that we're talking about timing the market here. And I think you'd be the first one to agree that what's happened over the last couple of years with Praxis has been partially, you guys know what you're doing, partially the luck of the market, but a lot of it's kind of seen the signs, kind of the recessionary signs or challenges and risks. And we talked a little bit about that last time, about syndicators that maybe are kind of over their skis in terms of how much they've taken on. And you've always talked about being conservative. So maybe you could talk a little bit about, you weren't trying to time the market. You were, I assume, looking at the signs, and you decided to make, with that information, make a decision.
Yeah, we've been through market cycles before. We survived the great financial collapse in 08, 09. I've been through the dot-com bubble of 2000. I've been doing this a long time, and we've seen this movie before, and we could see what was playing out, and we didn't really see the extent of how damaging it ultimately was going to turn out to be. And I think, anybody that's involved in this industry to a great degree will say that there's been a lot of damage done in the last couple of years. And we didn't know how deep it was going to be, but we knew that it was going to be unfavorable, and it's a lot more comfortable to get out and get back in. And so some of it is market timing, but some of it is luck. We could just as easily have been wrong and watch the market run up. Somebody asked me the other day, they said, if somebody would have told you in February of 2020 that a global pandemic was coming and that all these businesses are going to be shut down and everybody's going to be working from home and all this other stuff, would you have sold all your assets before that happened? And I said, you know what? I probably would have. And that would have been a huge mistake because, the market just shot up after COVID, and who would have expected that? So part of it was luck. We were right. Even a broken clock is right twice a day. And, maybe it was just luck. I like to think there was some skill involved and some good timing and having seen the warning signs before. So it was probably a mix of all of that.
Yeah. And it's one of those things too, where, you've heard this before, where some people will say they won't work with general partners or LPs that haven't seen a recession before. When I was younger, I was like, that's such a stupid thing. You could be or you could be a student of history. You can look at the 90s, .com, 07, 08. I started right around 07, 08 and investing in real estate and seeing kind of what we've gone through now. I'm having more appreciation for that sentiment, not because I've changed the way I look at it as much, but more so the actual what it takes to go through that process, the stress, going to potentially have to capital raise again, or have people, LPs come up on capital requirements. Just going through that, I don't know, it's a hard thing to quantify, but you're kind of battle tested. And if you can get through a recession and either preserve capital or give a return in the best case scenario, I feel like it is kind of a badge of honor, and I trust that person a little bit differently with my capital. What are your thoughts on that?
100%. And I talk about this a lot in the Hands-Off Investor, that, one of the best tests you can give is the length test, right? How long have you been in business? And if they haven't been through an adverse market cycle, it's really scary to invest. And I'll tell you why. Tony Robbins says that every human action is to either seek pleasure or avoid pain, right? And I think there's a lot of truth to that. And having been through an adverse market yourself, you feel what that pain feels like, and you never want to feel it again. And so now when warning signs come, you don't tend to dismiss it as quickly, where you go, that's just noise. You're like, this could make me feel like I felt 10 years ago. I don't want that to happen. I'd rather just get out, because the pain of like missing an upside is a lot worse than the pain of having to ride through a downside, especially if you're on our side of the table where you have to take those phone calls. So I think that you can be a student of history, like you said, but nothing teaches you a lesson more than experiencing it and going through it, and the pain of having to deal with those adversities. That's your best teacher. I always say, like, you don't learn anything when everything is going right. And you don't really learn anything that you just read about or heard about or watched. You really learn from your experiences and what you go through. And those lessons are invaluable and they're powerful.
It's like the great philosopher Mike Tyson says, everybody's got a plan until you get punched in the face.
Right.
And it really, as that phrase, it's funny, but it's also the fact that you come in with all these, we talked about this before, you and I, these IRRs, this and that, and none of that means anything when you get thrown into a recession, or you have just exogenous factors, a war, in Europe, or anything that just tilts that off, and then all of a sudden, that 27% IRR versus 31% IRR is a really meaningless conversation.
Yeah, well, especially when you're faced with 0% IRRs and 100% losses. And there's a lot of that going on right now, by the way. I mean, I'm hearing left and right stories from investors about how I'm getting these capital calls, or, the sponsor we're trying to decide, do we sell at a 70% loss, or do we try to hold on to try to get our money back? These are the kinds of conversations that are taking place, instead of, how many syndicators can I find to deploy my capital to? And, how many 20% IRRs can I find? That's not the conversation today. So it's changed quite a bit.
Yeah, for sure. I want to be a little mindful of the time. We've got a few more minutes here. I want to just get your take on, we've talked about what you've done at Praxis, what we kind of think is going on in the market right now. What's the outlook? Where are we at in the cycle, do you think, kind of generally? And what's your crystal ball say, Brian?
Well, my crystal ball tells me that on one hand, the fundamentals for residential real estate are still quite strong. Now, office fundamentals are just complete garbage. Retail fundamentals, I don't even know. I can't even comment. Industrial seems to be very favorable, but overall, the fundamentals for residential real estate, I think, are solid. People need a place to live. There's not enough housing units. The population hasn't been growing lately, but there were never enough housing units. So that side of it, I feel very confident about. I think that there's a lot of markets, especially markets that were very strong in, say, 2017 to 2022, are experiencing a large run-up in construction, and those new deliveries are having some massive headwinds against rent increases and occupancies and that sort of stuff. But I think that's going to blow over relatively soon, because nobody can start a construction project now, and getting the financing, if you can even get it, is expensive. And so I think construction is going to wane, and the kind of more natural supply demand dynamics are going to take hold, and rent growth will come back. But what happens with the cost of capital is a big question mark. And what happens with insurance, if you can even get it, is a big question mark. And so I think there's still a lot of owners that feel that values are going to run up really quickly. And so there's no need for them to sell now when they can sell later at a higher price. I kind of feel the opposite is true, that the prices really need to come down even more than they have in order for these deals to make sense. I was asking myself the other day, I said, how there are some deals getting done. And I'm like, how are these deals getting done? I can't figure it out. So I had somebody send me an investment offering for a deal, and I looked at it and I'm like, now I get it. Now I see how these deals are getting done. I was reading through the slide deck. It was loaded with misrepresentations. The returns were horrendous. Although they were saying they were good, I saw that what they were really doing was they were just distributing back people's money that they raised as distributions, right? Instead of actual cash flow from the property. There's no cash flow. And then they're projecting a sale with a made up cap rate that's below current cap rates. And it's like, that's how deals are getting done. Obviously, there's still enough investors out there that haven't read my book, because they're funding groups like this that are doing these really shaky deals. at inflated prices, and that's giving sellers the illusion that this property is worth the prices that some of these swindlers are paying. Well, eventually that dries up. And when it does, and sensible minds have to come back and you get the adults back in the room, I think we're all going to have to agree that in order for these transactions to work, the pricing is going to have to come into line. And so I think there's still some more movement on the downside that's left. And that's why we're sitting on the sidelines and waiting. And will that take 6 months? Will it take a year? Will it take 2 years? I can't tell yet. I guess we'll have to just wait and see. I don't want to be the first guy to buy. I can tell you that. I want to see some evidence that maybe we've bottomed out, and then we'll be ready to jump back in.
Well, that example just tells me that financial models have weathered the recession better than anybody. It seems like no matter what market you're in, you could get a model to tell you this or a model to tell you that. In terms of you touched on it briefly, the interest rate environment, provided what you say is true, the prices still need to come down, say they level out for a few years. To your point, I don't see how a lot of these deals make sense without putting 50% down on some of these properties. And even then, so what do you think is the trajectory of kind of interest rate, or where do interest rates need to be for these to start penciling out, even if we have kind of a leveling out of pricing?
Well, it's kind of funny. I heard an interesting quote a few months ago that I'd never heard. Warren Buffett is famous for a lot of quotes, but I heard one that he said the other day in an interview that really caught my attention. I thought that's a really hilarious way of thinking about it. He said, real estate is only worth what you can borrow. And, and when you really think about that, and you think about what happened in 2021, when you could only get 50 or 60% LTV before the property became coverage constrained, you knew that the price was too high, because 5 years prior to that, you could buy 75% to 80% debt all day long without getting coverage constrained, meaning you still had enough cash flow to service the debt at 75 to 80% of the purchase price. When you can do that, you're paying a fair price for the property. Now, when people are like, oh, you've got to put 50% down in order to make it work, it's like, well, wait a minute. That doesn't work. That's not what this is all about. Real estate is not stocks. This is not a cash business where you say like, oh, the way to get the best returns is to pay all cash and don't even do debt. BS. That's not how this business works. Instead, you got to get the price to come down where you can borrow 65, 70, 75%. When you can get to that point, you're paying a fair price for the real estate. Now, what does that price or interest rate have to look like? Doesn't matter. Interest rates could be 14, but your price is going to have to be at a point where you can get 75% debt at 14% interest rate. Now, that's not going to be a very good price, and you're probably going to be at 20 caps or so. I don't even know what the number is to get there.
You're going to be in Buffalo at that point.
Yeah, if you can even do that. But what I can tell you does not work is 5.75% interest rates at a 5% cap rate does not work. So either the interest rate has to come down to 4% for your 5% cap rates to work, or interest rates stay at 6 and cap rates go to 7, 7.25, 7.5, something like that. But 3% cap rates on Class C properties, like we were seeing for a while, that's long gone history. And you'd have to get interest rates back to zero for that price to work, and you'd have to have significant rent growth. And right now we have neither of those two things.
There's the movie with DiCaprio, Catch Me If You Can. I'm sure a lot of people have seen it, where there's a point where there's a sentiment about you've been getting away with something for so long that you're almost thankful that they caught you. I feel like when we were at the peak, and this is even before COVID, like you said, 2.8% caps, 3.2% caps. And you were just thinking, this cannot last. Like, something has to happen, or else real estate's never going to make sense to me again, because we're going up this path that just looked at the time fully unsustainable. But to your point before, like it's very hard to call when that point is going to be. And I think it would have taken, would have happened eventually. In our case, it was a very unique thing that kind of nudged it into what turned out to be a recession. But yeah, there was almost this feeling of, I'm kind of happy we're in this environment to a certain extent. I don't, wish any ill will towards anybody, but just getting a rebalancing of where these crazy valuations were for so long?
Well, this is going to cleanse the industry because there were a lot of people in this business that should never have been in this business. There were a lot of people that were accepting capital from investors who they had entrusted, who they never should have trusted. It's going to wipe out a lot of that, and that's going to reduce some of the competition on the sponsor side. Unfortunately, it's also going to sour a lot of passive investors who are like, I'm never doing that again. Real estate syndications are toxic. I'm never investing in those. You just lose your money. Well, it's not true. There's really strong operators out there that are putting together solid business plans and buying fairly priced property and will produce a good return for you. But when you make mistakes and invest in with the wrong operators, with the wrong capital structure and overpriced assets at the wrong time of the market, that never ends well. And so I think we're going to see that get cleansed out. As far as interest rates are concerned, the longer they stay where they are, the more damage it's going to do. But ultimately, the more opportunity it's going to produce. I mean, that's the thing about every one of these dislocations is they always produce some kind of an opportunity. And this will be the same. And at some point in the future, there's going to be some opportunity for solid operators with strong investors with strong stomachs to get back into the market and make some good returns on their investments. That's going to happen.
And more reason than ever now to pick up the Hands-Off Investor, Brian's book. Will get some more people on your side of the kind of the right way to do LP. Brian, thank you for coming on the show. For those that want to get connected or want to learn a little bit more about yourself or Praxis, where can we send them? We'll put some show notes up.
Yeah, best place is our company's website, praxcap.com. It's praxcap.com. They can also follow me on Instagram at Investor Brian Burke.
This has been Working Capital. Brian, my guest. Brian, thanks for being part of the show.
Thanks for having me.